Today, I'm looking at how Okta reacted in the face of macroeconomic slowdown, how Okta transformed its sales strategy, and what massive change happened to the company's financials for the first time in 7 quarters. Moreover, at the end of the video, we'll see the change in Okta's intrinsic value. The best place where we can see all these is in the financials. And we're gonna start with the most important aspect about a business future, its revenue growth. Okta's revenue surpassed the estimates for the 3rd quarter, and it's expected to grow 28% year over year in the 4th quarter. The growth is slowing for 3 reasons. Firstly, the integration difficulties around the 2 sales teams, especially around customer identity. Remember that Okta bought Auth0 in 2021, and the go-to-market strategies are totally different. Auth0 has a bottom-up, developers-first go-to-market strategy, which is different than Okta's top-down approach. Okta implemented a series of measures that helped the company achieve greater financial discipline, starting inside its sales and marketing teams. The second reason is tied to high attrition, which means that employees quit working at Okta at a higher pace than usual. Lastly, there's the difficult macroeconomic environment.
Adding to the challenge is a global macro environment that we anticipate becoming worse before it improves.
I believe that the revenue is growing nicely considering Okta's scale, and while these are some short-term growing pains, the company is making the first small steps in the right direction. Regarding margins, the gross margin is arguably the most important for a business. Okta's gross margin improved in the last quarters, sitting now above 70% for the first time since the Auth0 acquisition. Next, we need to look at the operating margins, and we're gonna start with the GAAP operating margin, which is deep in the negative but slightly improving. One major improvement that Okta promised in the last quarter is that it will be profitable on an adjusted base. This means that if we ignore the stock-based compensation that Okta pays to its employees, the company's core operation was profitable. That's one of the biggest improvements in the last earnings report, and Wall Street absolutely loved it. Looking at Okta's operating expenses, Okta's operating margin improved because the sales and marketing expenses remained flat, while the R&D and the G&A were slightly lower than the last quarters. Management implemented several spending reduction measures, including significantly reducing their hiring plans, since generally for tech companies the biggest expense is the workforce. In periods of economic downturn, it's easy for them to slow down on their hiring plans in order to improve margins. But how can we tell if Okta's go-to-market strategy is truly improving? We need to look at a crucial operating margin called the customer acquisition cost. This shows how much does Okta spend to attract $1 in contracted value. The customer acquisition cost grew slightly on a quarter-over-quarter basis, as Okta spends now $3 for $1 attracted in contracted value.
While we didn't experience a meaningful change in sales cycles, we are seeing signs that the environment has further weakened since we spoke last quarter.
The next chapter is definitely the most important part of the analysis. In a volatile environment, companies generating high amounts of free cash flow are usually rewarded by the market. Okta's free cash flow became positive after a really bad 2nd quarter. The free cash flow margin was around 2%, which is decent, but way below the range of 20% that Okta had before buying Auth0. And while you might be thinking that's not so bad since Okta generated free cash flow consistently during the last quarters, this is not true.
Man, what?
The free cash flow statement adds back all the stock-based compensation that the company pays to its employees, and if you're gonna take a look at the stock-based compensation, these are much more significant than the free cash flow generated. So if you take this into account, Okta has never generated any real free cash flow. To keep expenses in check, management follows closely a software operating KPI called the Rule of 40. It tells us how fast we can grow without burning too much money. Okta's Rule of 40 continues to decrease, as it sits now considerably below 40. This proves that if the revenue growth is lower, the company needs to improve its free cash flow margin in order to maintain a healthy balance. Next, let's look at the operating KPIs to see why Okta still has plenty of potential in spite of an economic slowdown. At the end of the 3rd quarter, Okta had more than 17,000 customers, growing 22% year over year. Nevertheless, let's look at customers with more than 100,000 in annual recurring revenue, since that's the most important category. Okta grew its enterprise customers 32% year over year, which is in line with the growth pace before acquiring Auth0. However, since upselling its existing customers is a crucial part of Okta's sales strategy, we need to look at the ratio between enterprise customers and the total number of customers. Okta has done an incredible job of upselling, as 22% of their customers spend more than $100,000 on the platform. The most important metric regarding customers is the net retention rate. It is calculated as the net expansion of annual recurring revenue for existing customers over the last 12 months. Generally, anything above 120% is a great value, especially considering Octascale. Next, the perfect way to tell how strong is future demand for software companies is by looking at the RPO. It consists of amounts that have not yet been recognized as revenue. RPO was relatively flat on a quarter-over-quarter basis, which confirms that demand for Okta services is slowing down. RPO is one of the metrics that I recommend you follow closely to see when Okta will get its momentum back. Next, let's have a bird's eye view on the cybersecurity industry. Authentication is one of the most difficult applications to build in-house, so the total addressable market is expected to continue to grow at a fast pace. Okta remains the identity access management leader alongside Microsoft. However, Microsoft improved its ability to execute as it managed to close the gap between the two competitors. Although Okta is a market leader and has achieved scale, there are still many risks regarding the stock. Firstly, the fact that the company doesn't generate any real free cash flow. Secondly, the high dilution for the average investor, and lastly, the difficult macroeconomic environment. In terms of valuation, although Okta is cheaper now compared to past valuation, let's look at what I believe to be the maximum price that you should be paying for Okta stock. I believe that right now, Okta is worth somewhere between $85 and $110 for the perpetual growth method, while for the EBITDA multiples method, its intrinsic value is between $95 and $120. However, please be aware that the market is very volatile, and in such periods, companies can remain below their intrinsic value for longer periods of time. From a technical perspective, following the results for the third quarter, Okta stock grew 25%. It seems like the stock is now consolidating, and I believe that the volatility will remain elevated in the first quarter of 2023. To sum up, I believe that investors appreciate the small steps that Okta has taken into improving its margins and its ability to generate free cash flow. Although Okta stock reacted really well following the earnings report, because of the macroeconomic environment, I believe that another leg down is very possible. In this scenario, the stock will probably revisit the $50 price range, so please be very careful if you want to open a position. Until next time, keep crushing it and subscribe.